After announcing its third quarter earnings, Google exceeded analyst expectations, adding $150 billion to its market cap. Is now the right time to buy before Google potentially reaches new record highs? Well, let's find out. You might have heard that Alphabet, Google's parent company, just saw its market cap surge by over $150 billion after their latest earnings report. The stock jumped 6% from $169 to $180, which got a lot of investors excited. But here's the thing, the initial surge hasn't quite played out as many expected. Should we be worried? Well, no. Let me explain why. What's happening right now is something we call filling the gap. After that 6% jump, the stock pulled back to trade at prices that were missed during the gap up. Now, if you're new to investing, this might sound concerning, but let me tell you, this is absolutely normal for Google. Let's look at some recent history. Back in April, Google gapped up 12% on earnings, then pulled back to partially fill the gap before continuing its upward march. In January, we saw a 5% gap down, followed by a recovery to fill that gap, a decline, and then continuation of the uptrend. And if we go back to October 2023, there was a 7.5% gap down before the stock filled the gap and resumed its upward journey. The key here, patience. Google has shown us time and time again that it rewards those who understand its patterns and have the patience to let them play out. But to really understand where Google might be heading, we need to look at its incredible journey. Back in 2004, Google did something pretty revolutionary with its IPO. Instead of the usual Wall Street approach, they used a Dutch auction system to give smaller investors a fair shot. Starting at $85 per share, they raised a massive $1.6 billion. Not bad for a company that began in a Stanford dorm room. What happened next was nothing short of extraordinary. It is one of those rare stocks that went straight into an uptrend. If you are a regular of mine, you will know how stocks like Nvidia and Palantir have remained in consolidation for years before their first major uptrend. For Google, from its IPO in 2004 to 2007, the stock soared 650%. Why? Well, because Google wasn't just riding the internet wave, they were creating it. Their pay-per-click advertising model revolutionized how businesses reached customers, and as more people came online, Google's revenue exploded. But then, the 2008 financial crisis hit and the stock market tumbled. Google's stock plunged almost 70%. Many investors would have sold during this uncertain period, but those who understood Google's fundamental strength and stayed invested, well, they saw the stock climb an incredible 2,350% from that 2008 low to the 2022 high. Even during COVID-19, when the stock dropped over 30%, Google showed its resilience. Post-pandemic, it surged another 200%. Why? Because Google kept innovating. They pushed into AI with projects like DeepMind, expanded their cloud services, and maintained their dominance in online advertising. Speaking of innovation, let's talk about something that often gets overlooked: Google's ability to turn seemingly risky acquisitions into gold mines. Take YouTube, for example. When Google bought it for $1.65 billion in 2006, many thought they were crazy. Fast forward to today, and YouTube has become one of the most valuable platforms in the world, generating billions in revenue annually. This wasn't just luck, it was Google's ability to see potential where others saw risk. And let's not forget about Android. When Google acquired Android in 2005 for just $50 million, few people realized they were witnessing one of the most strategic moves in tech history. Today, Android powers over 70% of the world's smartphones. This isn't just about market share, it's about Google's ability to see the future and position itself accordingly. Now, let's dive deeper into Google's current AI initiatives, because this could be the next major catalyst for stock growth. Google's investment in AI isn't just about chatbots or virtual assistants. They're working on everything from quantum computing to advanced machine learning algorithms that could revolutionize healthcare, climate science, and even space exploration. Their recent advances in AI language models and quantum supremacy demonstrations show they're not just participating in the AI race, they're helping to define it. But here's something crucial that many investors miss. Google's strength isn't just in its technological innovation, it's in its business model. The company has built what Warren Buffett would call an economic moat, a competitive advantage so strong it's almost impossible to replicate. Think about it. Google processes over 3.5 billion searches per day. Each search helps improve their algorithm, which in turn makes their services more valuable, attracting more users and advertisers. It's a virtuous cycle that gets stronger over time. Now, let's talk where the investment opportunity lies in terms of current stock setup. After hitting an all-time high in July 2024, Google pulled back about 23% during a challenging earnings season for big tech. While financial influencers were busy calling a market top, Google formed a base between $170 and $147 before that recent 6% gap up we discussed earlier. So, when should you consider investing? Let me give you two solid approaches. The aggressive play is to enter when the stock moves above its October high. The challenge is that it is still below the all-time high of $192, which could act as resistance. But look at Google's history. When the stock trends, it trends for years. The odds of seeing new all-time highs are pretty good based on historical performance. However, it may take some time to break through its all-time high. So this aggressive entry is for those who are happy to sit through the potential of further sideways movement before the next uptrend begins. For more conservative investors, waiting for a break above the current all-time high might be more comfortable. You'll miss some initial gains, but you'll have more confirmation of the uptrend. Already own Google shares? Well, the same levels work for you when it comes to adding to your position, what we call compounding. But here's a crucial pro tip. Only compound winning positions. So ensure you are already in profit before buying more of Google. Never add to losing positions. That's a fast track to destroying your portfolio. Let's talk about risk management for a moment, because this is crucial for success. When investing in any stock, even one as strong as Google, you need a clear exit strategy. I recommend using the 200-day simple moving average as your guide. Historically, Google tends to find support at this level during healthy uptrends. If the stock closes below this level, it might be time to reassess your position. Looking ahead, analysts are projecting some impressive numbers. The average 12-month price target is around $205, suggesting a potential 20% upside from current price. But I'd argue that's thinking too small. If $200 is reached, don't be surprised to see $300, $400, or even $500 as reasonable long-term targets, given Google's historical performance. Let the stock dictate, and you will be pleasantly surprised at how far it can and will go. Remember, Google moves in stages. It gaps up and down around earnings, fills those gaps, and then continues its upward journey. The key is patience and understanding these patterns. With projected earnings growth of 10.7% annually, revenue growth of 9.8%, and strategic investments in AI and cloud services, Google's fundamentals remain strong. Yes, there are risks, regulatory challenges, and fierce competition in AI and cloud markets, but Google's track record of innovation and market dominance speaks for itself. The bottom line, Google isn't just a tech company, it's become a verb. And in the world of investing, that kind of cultural dominance, combined with solid fundamentals and a proven track record of resilience, makes for a compelling investment opportunity. The key is choosing your entry point wisely and having the patience to let Google's proven patterns play out. While you're at it, check out the next stock, which is showing all the classic signs of setting up to be a top performer in 2025. Nvidia has risen 177% so far this year and should definitely be on your watch list for an investment opportunity in the new year. Watch this video for an in-depth look at this strong trending stock.